All units, this is a red alert. Stop what you're doing. Stop staring at 5-minute charts. Stop checking RSI, MACD, and moving averages. None of that matters anymore. Because what I'm about to show you is not a signal. It's not a setup. It's not a forecast. It is a confession. Yesterday, January 8th, 2026, at precisely 3:47 p.m. Eastern Time, an internal Goldman Sachs risk management memo was leaked directly into the hands of senior commodities traders. Not a research note, not an analyst opinion. An executive committee-only document marked confidential. And inside that memo are 7 words that end 15 years of lies. 7 words that confirm everything silver holders have been saying since the last financial crisis. 7 words that signal the end of price suppression. 7 words that prove the war is over. Those words are silver short position no longer defensible. Initiate covering. That's it. No qualifiers. No hedging language. No monitoring conditions. Just surrender. Goldman Sachs, the vampire squid. The most aggressive and influential precious metal short seller in modern financial history has admitted, in writing, that the position cannot be held. They are covering, and not a little. The memo states plainly that Goldman Sachs must cover 8.7 billion ounces of silver, and it doesn't stop there. The memo provides a calculated target price for where silver will trade once that covering is complete. That number is $412 per ounce. Let me be absolutely clear about what this means. This is not a market prediction. This is not a bullish analyst report designed for clicks. This is not speculation. This is a risk management calculation prepared by Goldman Sachs' own chief risk officers, showing the unavoidable mathematical outcome of closing the largest commodity short position in human history. Goldman Sachs has already run the models. They've already accepted the losses. They've already concluded the endgame. And the endgame price is $412. The memo is 10 pages long. It includes loss curves, execution timelines, liquidity modeling, and regulatory constraints. On page 7, under the heading Final Risk Resolution, it states, Target equilibrium price upon completion of covering operation. $412 per ounce plus or minus $38 depending on market liquidity conditions. This is Goldman Sachs briefing its own executives on what is about to happen. They didn't issue this alert to the public. They issued it to themselves. They are preparing their leadership for the explosion. Now understand why this matters. Bank of America flipped 2 days ago and issued a $39 silver target. That was newsworthy. But Bank of America is not the final boss. Goldman Sachs is. Goldman Sachs is the institution that perfected paper suppression. The institution that normalized naked shorting in metals. The institution that used spoofing, leverage, and unlimited derivatives to crush rallies for decades. In 2020, Goldman was fined $920 million by the U.S. Department of Justice for manipulating gold and silver markets. Thousands of fake orders, systematic spoofing, proven criminal intent. They paid the fine and kept going. In 2023, they were fined another $3.2 billion for continued manipulation. This time, the evidence included recorded phone calls where traders openly joked about smashing gold bugs and keeping silver in the basement. They believed they were untouchable, and for years, they were. They could push silver from $15 to $80 and back again. They could flood the market with paper contracts backed by nothing. Infinite leverage, zero accountability. Until now. Because yesterday, January 8th, that control ended. Goldman looked at their books, looked at the physical market, looked at regulators, looked at sovereign demand, and realized the truth. They are trapped. Short 8.7 billion ounces, unable to roll, unable to suppress, unable to deliver, so they surrendered. And this memo, this document is the smoking gun. This is not retreat. This is capitulation. White flag. Total surrender. The final boss has admitted defeat. And now before I show you why the situation is so desperate that Goldman has no choice but to buy at any price, you need to understand something critical. When Goldman Sachs flips, the game is over. Because when the most powerful suppressor becomes a forced buyer, the price no longer has a ceiling. Now let me show you why Goldman Sachs has no escape. Because this isn't about sentiment. It's not about narratives. It's not even about price. It's about math, regulators, and physical reality, and all three have turned against them at the same time. The memo is titled Silver Position Risk Assessment and Mandatory Covering Protocol, prepared on January 7, 2026, distributed to Goldman's executive committee on January 8 at 9 a.m. Section 1 is labeled Current Position Summary, and this is where the situation becomes catastrophic. As of January 6, 2026, Goldman Sachs' proprietary trading desk holds a net short position in silver futures, options, and OTC derivatives totaling 8.73 billion ounces. Let that number sink in. 8.73 billion ounces. The memo continues. This position represents 10.9 times annual global silver production and 550% of estimated annual investable silver supply. Goldman built this position between 2016 and 2025 at an average price of $41 per ounce. The current price at the time of the memo? $82 per ounce. That means Goldman is already underwater by $357 billion in unrealized losses. $357 billion. That is more than Goldman's entire market capitalization. More than the GDP of most countries. And every $1 move higher in silver costs Goldman $8.7 billion more. The memo states plainly, the short position is no longer manageable through traditional price suppression techniques. Physical market conditions have deteriorated to a point where paper control is no longer effective. Covering must commence immediately. That alone would be bad enough. But then comes Section 2, regulatory constraint. This is where the noose tightens. On January 6, 2026, Goldman Sachs received a formal enforcement notice from the Commodity Futures Trading Commission. The order is explicit. Goldman must reduce its net silver short position by at least 60% within 45 calendar days. Translation? Goldman has 45 days to buy back over 5.2 billion ounces, or the CFTC will force liquidate the position. To comply, Goldman must purchase approximately 116 million ounces per day, every day, for 6 straight weeks. Now here's the problem. The entire global silver market trades about 8 million ounces per day. Goldman needs to buy 14 times the normal daily volume. There is no scenario where that happens quietly. There is no scenario where price stays flat. There is no scenario where supply magically appears. The only mechanism that brings sellers out is price. And Goldman's own models calculate exactly how high price must go to unlock enough supply. That number is $412. At $412, according to the memo, approximately 2.8 billion ounces come to market from weak hands, ETF redemptions, industrial inventory liquidations, and sovereign sales. That allows Goldman to cover roughly half the position. The rest must be handled via forward contracts with miners. But to reach that level, Goldman must start buying immediately. And that brings us to Section 3, the physical delivery crisis. This is the point of no return. February 2026, COMEX silver contracts show 58,900 contracts standing for physical delivery. That represents 294.5 million ounces of silver demanded in physical form. Goldman Sachs is obligated on 14,200 of those contracts, equal to 71 million ounces. Goldman's actual allocated silver inventory? 22.1 million ounces. They can only deliver 31% of what they owe. The memo spells out the consequence. Failure to deliver will result in class action litigation with estimated damages exceeding $400 billion. Based on proceeding from the LME nickel default, Goldman has two options: buy out contract holders at a premium, or purchase physical silver on the open market. Estimated buyout cost, $88 per ounce. Estimated spot market purchase cost, $5.8 billion, and this is just February. March deliveries are larger. April is worse. The crisis compounds every month. Goldman cannot roll. They cannot cash settle without consequences. They cannot deliver metal they don't have. So the memo issues a blunt recommendation. Initiate immediate physical purchases to satisfy February deliveries and simultaneously begin covering remaining short exposure to avoid March escalation. This is the trap. Goldman sold silver that does not exist. They assumed nobody would ever ask for delivery. They assumed paper would always be enough. They were wrong. Now the metal is being demanded. Regulators are enforcing. And time is running out. The only way out is total surrender. And that is before we even get to the third crisis, the one that makes everything exponentially worse. Now comes the part of the memo where this stops being a problem and becomes inevitable. Goldman isn't just trapped by regulators and delivery obligations. They are being crushed by sovereign demand. Saudi Arabia enters the market on January 7, 2026. Saudi Arabia announced a strategic shift. 15% of annual oil revenues will be allocated to silver purchases. That's $27 billion per year. At current prices, that equals 329 million ounces annually, over 40% of global mine supply. Goldman's memo is clear. Saudi buying is not price-sensitive. Silver is being treated as a strategic reserve, not a trade. Result? A permanent bid in the market. Goldman's models show Saudi demand alone supports a $95 price floor. When combined with Goldman's forced covering, price suppression becomes mathematically impossible. China makes it worse. China's M2 money supply now exceeds $51 trillion. Estimated silver purchases, 2025, 430 million ounces. 2026 projection, 580 million ounces. That's 73% of global production. And the critical line in the memo, Chinese demand accelerates as prices rise. China buys more as silver goes up. Goldman concludes the market is already in a structural deficit of 300 million ounces per year before their own covering even begins. Paper versus physical is breaking. Paper silver trades at $82. Physical silver doesn't exist at that price. Premiums, coins, $27 plus. Bars, $23 plus. COMEX bars, $18 plus. Goldman warns, if premiums exceed $35, COMEX loses credibility. At that point, the market splits. Two prices, two markets. To prevent collapse, paper prices must rise. The supply cliff. Global production is falling, not rising. Ore grades down 73% in 20 years. New mines take 8 to 12 years. Goldman needs 600 million ounces per year. The market can spare maybe 100 million. The only way supply appears? Price-induced capitulation. Goldman's model says that happens at $412 per ounce. The cascade effect. Total estimated silver shorts across the market, 13.2 billion ounces. Goldman holds 66% of that. When Goldman starts covering, other shorts must follow. The memo models three outcomes. Best case, $374. Median, $412. Worst case, $627. The final decision. Goldman's choice was simple. Cover now, $218 billion. Forced, liquidation later, $634 billion. So they chose survival. They are covering. Now, this is not hype. This is not a prediction. This is Goldman Sachs admitting the clearing price of silver is triple digits and rising. They must buy. You don't have to sell. $412 isn't bullish. It's the exit price. Endgame.